Hello friends, let's understand what is GST Compensation Cess. The Goods and Service Tax Compensation to States Bill 2017 was introduced in Lok Sabha on March 27, 2017. The bill provides for compensation to states for any loss in revenue due to implementation of GST. Period of compensation. Compensation will be provided to a state for a period of 5 years from the date on which the state brings its state GST into force. The base year tax revenue consists of states' tax revenues from first, state value-added tax, second, central sales tax, third, entry tax, octroi, local body tax, fourth, taxes on luxuries, fifth, taxes on advertisement, etc. However, any revenue among these taxes arising related to supply of alcohol for human consumption and certain petroleum products will not be accounted as a part of the base year revenue. Step-by-step calculation of the compensation cess amount. Step 1. Revenue for the financial year 2016-17 is considered as the base revenue for the state in consideration. Step 2. Growth rate of the state is assumed to be at 14% per annum for the 5-year period over which GST cess is applicable. Based on this, projected revenue for a particular financial year that a state could have earned in the absence of GST is calculated. Step 3. Finally, the compensation amount is provisionally calculated and released in every 2 months during the transition period. This mechanism is currently expected to be in effect till 1st of July 2022. As per Section 7C of the GST Act 2017, the total compensation cess payable to a state in any financial year equals the difference between the projected revenue for the financial year and actual revenue collected by the state. If after the end of this transition period there is any surplus money in the total compensation fund, it will be distributed between the states and the center using an appropriate formula. Levy and compensation of GST compensation cess. A GST compensation cess may be levied on the supply of certain goods and services as recommended by the GST Council. The receipts from the cess deposited to a GST compensation fund. The receipts will be used for compensating states for any loss due to the implementation of GST. The cess will be capped at 135% for pan masala, second, Rs 400 per ton for coal, third, Rs 4170 plus 290% per 1000 sticks of tobacco, and fourth, 15% for all other goods and services including motor cars and aerated water. Any unutilized money in the compensation fund at the end of the compensation period will be distributed in the following manner. First, 50% of the fund to be shared between the states in proportion to the revenue of the state. And second, the remaining 50% will be part of the central's divisible pool of taxes. What are the shortcomings? Utilization of transfer compensation is not monitored by center. For example, refilling of state fiscal deficit. There is no relation between the payer and the compensation receiving state. The goods listed for the cess, such as below mentioned, form a heterogeneous list. Aerated drink, coal, tobacco, automobiles and other supplies. The term other supplies leaves much to the discretion of the government. Luxury goods and jewellery are not covered. Applicability for import and export. Import. The compensation cess on goods imported into India shall be levied and collected in accordance with the provisions of Section 3 of Customs Tariff Act 1975. Export. Compensation cess will not be charged on goods exported under bond, and the exporter will be eligible for refund of input tax credit of compensation cess related to the goods exported. No compensation cess on supply under composition scheme. Actual data. For financial year 17-18, we can see that the total compensation given to the state was 65.73% of the collection by the centre. And for financial year 18-19, the compensation given to the state was 72% of the actual collection by the centre. The centre has already delayed compensating states for shortfall of GST revenue in financial year 2019-20. This may be due to reduction in collection of the compensation cess by the centre. We can conclude by saying that the centre should take appropriate measures to make good this delay, and if the loss to the state continues, then measures should be taken to restructure the GST model. The centre has the following options available with it to fill this deficit. First, revision of the compensation cess formula. Second, increase in the rate of composition cess or prescribing more commodities to be leviable under the cess. Third, borrow funds from the market.